Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 3rd of April 2022. How can you double your stack of gold without earning the extra fiat to buy more? Well, there's one way of doing that. Let's take a look. So the method I'm talking about is ratio trading. So here we've got a monthly chart of the gold-silver ratio. And so on this chart I've marked out, if you bought 1 ounce of gold here when the ratio was at 20 and held it, and then when the ratio went up to 100, you swap that ounce of gold for 1 ounce of silver. And then when the ratio comes down to, let's say, 50, then you swap that 100 ounces of silver back into gold, you get 2 ounces of gold. And so from here to here, you've doubled your gold. So that sounds pretty straightforward in principle. And yeah, look, it is certainly a possibility. But there are a few things that you have to consider before going ahead with using this idea. So I've used the gold-silver ratio as an example, but basically any two assets can be compared using ratios. And the ratio basically gives us an idea of the relative valuations of whichever two assets you're comparing. It also removes the currency component and therefore also excludes the effects of inflation. So for all of these reasons, I think it is useful to look at asset ratios. But as I said, there are issues that we do need to be aware of if we're considering trading using such ratios. One issue is that it assumes that the ratio mean reverts with oscillations to extremes either side of the mean. And so, I've done an example here. In this one, the mean is increasing over time and the ratio is oscillating like this. Now, if that assumption is correct, then what you need to do before you decide to trade this is first of all to look at the amplitude of the oscillation. So we're talking about from the peak to the trough. If it's a small oscillation, it might not even be worth bothering about. And then, of course, the other thing you need to account for is the time taken to go between peaks and between troughs. And they're not necessarily going to be equal either. And the reason you need to do that is that will help you estimate how long you can expect for your trade to take to, come to fruition. We also have to note that this mean reversion assumption isn't necessarily always correct. This chart looks at almost 8 centuries of the gold-silver ratio. And we can see here that up until the early 1800s, here you can see the amplitudes are actually pretty small. And then once we got into the 1800s, you can see that the mean started rising steeply. And we got those oscillations about the mean there. And so what's happening here is that the peaks are getting higher, but so are the troughs as well. So the lesson here is that you do need to watch out for macro factors that might affect the asset ratio. So it's going to be specific to whatever ratio you're looking at, really. The next assumption is that we are smart enough to know when the peaks and the bottoms are going to occur. So let's go back to our example. So the person who had swapped his 1 ounce of gold did pretty well here to swap out. And I would guess that the person would be expecting this ratio to drop down to roughly where it was, let's say between 20 and 30. And, if we're looking at that mean reversion assumption, then yeah, that's realistic. I mean, it's been there a couple of times before. But as you can see, it didn't get there. It kind of stopped just below 50 here. And in fact, it still hasn't reached that level between the 20 and 30. And so with that expectation, the chances that this person would have actually gone ahead and swapped into the gold seems quite slim, you know. Some people have misconceptions about what the ratio actually means when it comes to the price of each asset. The ratio doesn't tell you about the absolute price moves, it just tells you about relative prices. So, for example, when the gold silver ratio goes up, then it either means one of two things. It could mean that the price of gold has risen more than the price of silver has risen, or that the price of gold has dropped less than the price of silver has dropped. So coming back to our example, let's say this person had bought an ounce of gold over here when the ratio had bottomed out here. Note here, I've written here what the actual kind of metrics were. So at the time, the gold-silver ratio was 16.5, but gold was $600 and silver was $36.50. So as the ratio rose, when it got to about 100, the gold price was actually almost half of what it was here, and the silver price was almost a tenth. Ouch. And so, you know, just because the ratio went up, all this is showing is that the relative prices of these, silver dropped a lot more than gold did, basically. And so if they waited again, so they'd bought the silver at this point and then waited and then sold at this point, then we've got the gold silver ratio of 50. Gold price was $296 and silver was $6. So that's this kind of is explaining how this doesn't account for fiat changes. So just because the ratio went up doesn't mean that you've made fiat value on your precious metals holdings, shall we say. This is purely about how much gold and silver you've got. Now, of course, you can also, obviously I've picked that as an example, but remember that this was during a bear market. Obviously, you're going to get a different result if prices have bottomed and you're entering a bull market. So I'll leave you to kind of analyse that yourself to determine, you know, what's the best strategy there. The point here is that by doing this trading strategy, this person doubled their gold stack over this time, but that doesn't necessarily mean they profited in fiat terms. In fact, they're roughly the same amount here, 600 for 1 ounce, and here it was roughly 600 for 2 ounces. When trading ratios, long time frames are involved, and therefore the opportunity cost has to be taken into consideration. Back to our example, that trade that we discussed basically took 18 years. So that's 18 years to double the gold stack. But remember, over that same time frame, the S&P 500 went up 6-fold. In the example given, doubling of the stack wouldn't have actually occurred in reality, and that's because it didn't really account for the costs involved in the trade as well. So these costs will vary depending on what the assets you're including in the ratio are, but examples include trading fees, premiums, storage fees, and taxes. And so these all eat into profits. So if you're going to be doing this, you've got to take these into account and try and minimize them. Now, obviously, if you live in, for example, a jurisdiction where there are no capital gains tax for, you know, for gold or silver, then you're going to be at a much more an advantage compared to someone who's taxed, say, 30% on their gains. In conclusion, ratio trading is not really an easy thing to do. If you are going to do it, then it's best done when the particular ratio you're looking at is at an extreme. You must also be patient. In the case of the gold-silver ratio, we're talking many years. You must also be clear and realistic about what you're going to expect to achieve. So success with this is possible, but you must set your expectations realistically. Next up, the market update. Well, the US 2 to 10-year yield has officially inverted. We are now below zero. So that means something's coming down the pike. Usually there's a lag, could be 6 months, could be 2 years even, but something's coming. And this is the early warning sign, and it's got a very high reliability historically. So warning sign there. But usually it's not imminent. It's not going to happen in the next month or so, that kind of thing. Usually it's pretty rare. Okay. Gold priced in US dollars on the daily scale, and we're still in that little sideways movement here. Now, interestingly, we've been looking at this Fibonacci first of all. There's quite a few things on this chart, so we'll go through them one by one. So the first thing we were looking at was this Fibonacci retracement here, and this time we hit that 0.618 level to the tick, it looks like on there, doesn't it? Does that mean that this is over? It could be. So we'd want to see a nice push up coming up. The question is, of course, is this just, still consolidating and then one more downside? If that's the case, well, then we'd be looking in terms of downside targets. I'm thinking around the 1840-ish. That would fit with this Fibonacci level. We've got plenty of support here. I think the probabilities of going below this 1800 level are pretty low, I'd say. One of the things here, I've put the volume by price over this whole long, boring consolidation here. And you can see here again by volume, we've got a lot of support here around the 1800 as well. At the moment, we're over here, which kind of corresponds to this volume bar here, the bottom of this volume bar. So we've got support over here as well. So, for us to get to this 1840 level, we still have to chomp through quite a bit of kind of resistance, I guess, on the downside there. The other thing is that we did get a kind of quite a sharp rejection off that around 1900 level there as well, which is quite positive there. There's a long lower wick. So two possibilities are that this is all over and what we're looking at is this. And then I think the other, probably I'd put that the second possibility. I think for me, this looks like the first one. And as we go through some of the charts, you'll see why I'm erring towards that side. But yeah, the second highest probability I'll be thinking of would be a drop to around here before going to the upside. Silver, interesting. So we've got this, this is the 200-day moving average. Now, if we go back to gold, again, that would kind of roughly correspond to that if we are to retest that. Now, if we're in a bull market, it doesn't even have to go near that. It can just keep moving upwards and just drag it up with it. So, but, if we are thinking downside, that's another support area there as well. So with silver, we actually did hit the 200-day moving average over here, and very, very harsh rejection off of that, bounced up very nicely. So I quite like that. It was just a smidgen short of the 0.618 though. That's the only thing. But does that matter? I don't know that it has to be absolutely exact with these things. Anyway, so bounced off of that, we're drifting down a little bit. And I think if we are going to turn around, we'd have to turn around pretty soon from here and start making our way up there, similar to gold. If there is more downside, what the areas we're looking at, we had talked about the 23. I think that is the maximum. And that's also fits with one of the trend lines that I'd drawn earlier as well. So also, you know, we've got a bit of support over here as well. So it would take something very dramatic for me to change, you know, and for that to kind of drop below that. But hey, with silver, we know anything's possible. But yeah, downside potential there. But look, I don't know, the fact that it bounced off of that 200-day moving average pretty sharpish just makes me feel a bit more positive about silver as well. So I think we're going to get a turnaround and move up here. And of course, we've still got that overhead resistance around this 26 level. So what we really want is for that to become support. So why else am I feeling positive about silver? So this is silver priced in New Zealand dollars on the weekly scale, and we'd looked at this earlier just because it's got a much nicer look to it in terms of the pattern, and we talked about this descending triangle pattern over here, and it had broken out within the time frame we were expecting it to. Not only that, it broke out with much higher than average volume, which is a positive sign. As it's dropping back on low volume, which is another positive sign. And what's happened is, it looks to me like, you know, we broke out and we're just retesting this trend line here. Now, although it dropped below that trend line, it hasn't closed below it. So again, that's another positive thing, and it's quite common for it to do that. You get the breakout, retest, and then start moving up from there. So that's another kind of reason why I'm thinking that. Of course, you know, what could go wrong? Well, it could be that we've got completely the wrong pattern here. Sometimes you can draw these lines prematurely. To me, it looks pretty good, but, you know, you've always got to look for what are the possible things that are wrong. And one possibility is that we should have drawn it to intersect with this one. It's a much bigger descending triangle. But if that's the case, then we'd be looking at going a lot longer over here for a couple of years before we get a breakout. And I just don't see that as being likely. And this whole volume thing as well just makes me think that that's not the case as well. Another thing is looking at the premium. So this is for physical silver. The premium over spot is just creeping up quite substantially. I mean, you know, 50 to 60% here now. So we're getting at the highs that we've had previously as well. So people want the physical, and demand is high according to this. Let's look at the minus. This is the GDX on the daily scale. And so first of all, we've got this downsloping trend line, and we had a breakout above it. It never really got as far as retesting it completely. It doesn't have to. So it's looking pretty strong. What I did here, I thought, well, look, let's join the very low here to these two lows here, three lows here. So that seems like a pretty good trend line. And interestingly, this bar here hasn't quite touched it, but it's pretty close before bouncing off. So is that a valid trend line? You know, is that a good trend line? It's got lots of touches. Is that going to hold? What else can we look at here? Well, the other one is the volume by price. And at the moment, we're up here. Okay, so we're actually above this bar here. This should provide quite a bit of support here, and it seems to be that is the case. We've kind of gone through there and moving upwards, and the higher we get, the lower the volumes are getting over here, which means there's more thin air. So if we were to drop, then I think we were talking previously about levels down around 34, because that's where the trend line is. And look, yeah, it could potentially retest that trend line. Volumes suggest the maximum kind of support is over here at 35. So if you are thinking more downside, then that's what we're looking at. But this is looking pretty strong. You got to admit that it's looking pretty strong at the moment. So yeah, I think as we're already here, you know, we might do something like this and then carry on up. And another reason that I'm quite positive about the miners, so this is the GDX to gold ratio, and this is on the weekly scale this time. And so what we've done here is join these two highs here and these two lows here. So we've got this channel and we've broken out of that channel here. And that's quite a decisive breakout there. So from here, you know, we're looking at a target above this level here, really. And so this suggests that the miners are going to continue to outperform. Also, I mean, you could call this a small kind of double bottom as well, so that can help you with the target, or even the height of this channel can help you, give you a target. But remember, this is the ratio. So we had, I think in the last couple of weeks, we've had times where gold went down, but actually the GDX went up. And so that's the cause of this here. And next, the silver junior miners on the weekly scale. And so this is the full history for this ETF. And we've been looking at this big kind of consolidation triangle pattern. It's massive, isn't it? It's absolutely massive. So the actual final outcome of this pattern is going to be epic. Really is going to be epic. And for that to occur, we need a breakout above 1735. That will be the start of an epic run, I reckon. Anyway, in the meantime, we're still stuck in this consolidation, and we've had some nice moves up there. It looks like it's having a rest at the moment. At the moment, we're over here, and I was looking at the volumes over here. We still got some overhead resistance to overcome. We've got a lot of price action over here in particular, so we really need to start pushing up through there. I mean, it may be, so what's happened here is that, you know, we've come up, we've hit that, and we may stay here for a little while before we get up through there, so it's going to be a bit volatile potentially. And so it's the 1540 we really need to gain support on. So we need to go above there, get support on there, and then of course the next one is around the 17s. It depends how long it takes to get above there, but we need to find support there. Over here you can see that we got over that line a couple of times, but it never stayed there. It didn't hold as support. It just blasted through there and blasted back down again. So we need to see something like price go up through here and then do that, or just that. That would be even better, wouldn't it? Okay, but yeah, I'm looking positively at the precious metals and miners at the moment. I think the downside is relatively small, and the upside is asymmetrically large. And of course, finally, we'll look at the SILJ to silver ratio, and again, the silver miners have been outperforming silver as well. So similar to what we saw with the GDX to gold ratio. And the target we're looking for a big move is above this level here, which is about 6.6, shall we say. And so that's a long-term line there that we've got. Wouldn't it be great if we saw something like this happen? That was amazing, wasn't it? Epic. Right. Anyway, I hope you've all had a good week and are enjoying the weekend. All the best, and we shall see you next week. Bye.